Hi, this is a quick video explaining the answers to central question number 1 during the fall of 2011. And this is the one that talks about the yoga clothing store that's supposedly in Selwood. So let's start with question number 1. And question number 1 says you're opening a yoga clothing store in Selwood, so you rent retail space month to month for $1,500 a month. Now, we did it month to month so that you didn't have to get anything that's complex with, well, it's a long-term lease, it has asset and liability attributes to it. No, what we're looking at here is that you just have this increase in your operating expenses that's there, and that's all we want to do is focus on the expense part. Because you have this increase in operating expenses, you're going to have this decrease in net income, and you're also going to have a corresponding decrease in cash from operations. Remember that we're putting kind of a barrier right here in between the income statement and the balance sheet so we don't have things flowing over too much, and this is essentially the rule that we're going for, is things that change the income statement end up changing net income. Anything that changes net income ends up flowing over one way or another and having an effect on operations. So look at question number 2. This will end up being in red so you can spot it. You have to do some fixing up the space. You pay some contractors to install hardwood floors and energy efficient lighting. So what's nice there is that you're paying somebody, so you've got some current assets. This is your cash decreasing. And what you're doing with it is you're purchasing other fixed assets. That hardwood floors, energy efficient lighting, those are all fixed assets, so you've got an increase in assets right there too. Now this balances out already in the balance sheet. Remember, the balance sheet must balance. So this decrease in one kind of asset was balanced off by an increase in another kind of asset. And please note that part of the transaction was actually cash, and so what you saw was cash flowing out. So what you're seeing is a decrease in cash from investments. So that's what you should have for question number 2. Question number 3 will be in green. That says you purchase a cash register, some clothing racks, shelving, and mirrors and other equipment for the store on credit. Now this one's pretty easy too. As you notice, you're getting all sorts of assets that are right there. That's the cash register, the clothing racks, the shelving. And at the same time, you're taking out a loan to finance it. So there's this increase in liabilities too. So the increase in assets should be about the same scale as the increase in liabilities, so your balance sheet balances. Cash flow ends up being a little bit complicated. You're buying assets, so you see a decrease in cash that's there from investments. And you're borrowing money, so you see an increase in cash from finance. Because you saw in this particular transaction that there was no net change in cash, these two arrows right here balance each other out. It's important because when you start paying off the loan, you'll have decreases in cash later on. That doesn't happen in this example. Next one. And this one will be in blue. You pay $1,000 to certify some of your staff to teach yoga classes. Because we're talking about people here, what this should be is actually an expense that's there. So you have an increase in operating expenses, and this should work exactly like question number 1. Increase in operating expenses means you have a decrease in net income, which means you have a decrease in cash from operations. Piece of cake. And again, it's because it's people and we can't buy people. It doesn't turn into an asset or anything like that. 5, which we'll switch back to black for a while. You inherit some money and decide to put it towards your business. All that we're looking at here is you, the owner, putting more money into the business. So the business actually gets this increase in cash. So that's an increase in assets that are right there. And it's balanced off by an increase in owner equity. And so there's another up arrow there. So please note the increase in assets is exactly equal to the increase in owner equity. Now, notice that we got cash in there. The cash has to show up somewhere on the cash flow statement, and it turns out that for the most part, changes in owner equity ends up being reflected in the cash flow statement over here in the finance section. So you've got this increase in cash. Remember, positive numbers means cash flowing in over in the cash flow section under finance. So that's 5. 6 will switch to red again. The number of people coming to your yoga class doubles. The implication is that your revenue is going up, your net income goes up, and your cash from operations also goes up. So we don't have it quite flow over to the balance sheet yet, so hold off on that. We're trying to keep things nice and simple. It's just one of our operating rules. Now, let's go ahead and switch to green for number 7. One of your customers files a lawsuit against you claiming yoga pants sold him were too tight, cut off circulation to his feet, causing permanent damage to his warrior pose. You have to pay for a lawyer. Guess what? That's also an expense, which causes a decrease, and a decrease in cash from operations. So please note there's a couple of these that are exactly the same. Checked off, and then switching to blue for the last one, you end up having to sell some of your equipment and inventory at a pawn shop to get some cash. Now we said sell. So what we're doing here is taking some assets, and this is, that equipment, and you see this decrease that's right there. And what you end up doing is having a increase in cash, and so that bounces off right there because you are selling these assets. Purchase and sale of assets gets reflected in cash from investment. You have an increase in cash from investments. Remember, cash flow statement is watching cash. Thank you very much, and good luck on the rest of the essential questions.